Hello everyone, welcome to the Property Investment Masterclass. My name is Paul Stewart from Elite Wealth Services, and I've been providing IFAs, accountants, solicitors and entrepreneurs with access to independent specialist tax and business planning advice for the last 30 years, and I'm looking forward to being of assistance to help you. First of all, there's a lot of information out on the internet with regards to property and pensions. A lot of it talks about what you cannot do. What we want to explore here within this little video is to highlight some of the things you can do. However, the main objective with regards to any type of planning shouldn't be to avoid tax. It should be to make your affairs more efficient. It should be for provision for your family or retirement income. And it's very important that we get the motivation correct right from the start. Nothing that we've ever done and nothing that we will ever do can be constituted as a tax scheme. So you don't have to worry that we're going to be putting things in front of you that are what I would call slightly dodgy. We don't get involved with tax avoidance at all. We use statutory rules and existing arrangements. The only issue is that you may not have come across them yet. For whatever reason it is, it could be that your advisors don't specialise in this area or haven't come across how they can be implemented safely and correctly. We do help UK residents that live offshore, as they will still have an inheritance tax problem. So if you're outside of the UK but are domiciled in the UK, then don't hesitate to get in touch. Remember, this is just a simple overview video. It's not designed to be a technical training course for people to be able to implement things themselves. It's just to give you a flavour. One thing I can offer you as a bonus, which is for the first 75 people who email me with the email address at the end of this video, I'll be offering them a free consultation of their personal circumstances, which would normally cost £500. So please, when you get to the end, you'll see the email address. Just drop me an email and then we can take it from there. I look forward to being able to assist you, and here goes. The first thing we need to look at in terms of property is what the current exposure to tax may be. So, for example, you have rental income and there'll be tax to pay on that, which could be corporation tax or it could be personal tax, it could be trustee tax. It does depend upon who owns the property. There will also be taxes on growth in the property, capital gains tax, if the property is to be sold. There's also stamp duty on the purchase and also transfer of property. There's also additional stamp duty to pay if this is your second, third, fourth, so on properties. There's also another tax, which is the annual tax on envelope dwellings, which is a fee payable annually on properties that are held within companies and trusts. Again, we can assist with removing that tax burden. Even when you die, the taxman still has their share of things. And as you all know, there's inheritance tax, which is currently 40% on death. So your exposure to tax from the buying of a property, the owning and the selling of a property and beyond is quite significant. And our role is to give you support and advice on restructuring things more effectively. We're going to be talking about pensions, so I thought I would start off by giving you a little bit of an overview of the sorts of things that are the perceived wisdom, the things that we should all know about. There are personal pensions. There's a thing called a SIP, which is a self-invested personal pension that your advisors may have told you about. There are also company pensions called SSASs, small self-administered pension schemes. And again, those are very useful arrangements to assist you in terms of property. And some of you may already have property owned by a SSAS or indeed a SIP. And as you know, with pensions, there's no tax on any of the capital growth within the pensions. There's no 40% tax on death. You've got access to tax-free cash should you need it at retirement. You can get involved with commercial property investments. However, with SIPs and SSASs and other pension arrangements, there tends to be a big no-no to residential property. And that's one of the key areas that we can assist with. There's also borrowing limits within pensions, the loan to value, the maximum mortgage that you can get on a property owned by a SIP or a SSAS. It can be as low as 35% loan to value because there are pensions rules. You've also got limited contribution levels. 40,000 is the maximum that you can contribute and get tax relief on contributions. However, there are arrangements where you can get tax relief on much larger contributions. Again, we will chuck those into the mix as we go through this little video. And there's a lifetime limit on the fund that you can achieve, which is currently standing at 1.05 million. And it may sound a lot, but actually that doesn't go very far in terms of generating what you need in terms of your income. So again, there are arrangements that can go beyond that, and that's the purpose behind the video, is to explain that there are other tools that can be used. Talking of which, I want to introduce you to two of them now. The first one is called a QNUPS, and this is not to be confused with a pension arrangement called a QROPS. So QNUPS, and this is an arrangement which is available for UK and non-UK residents. But what are they and what can we do with them? First of all, the name QNUPS is a bit of a strange one, but it stands for Qualifying Non-UK Pension Scheme. And as the name suggests, they qualify under HMRC's rules and regulations for certain tax benefits. And they were actually introduced by HMRC in 2010 as a way of allowing people to uplift and enhance their retirement income. And that's the purpose behind a QNUPS, to provide you with the income that you need when you come to retirement. A QNUPS as a pension will give you access to tax-free cash, so it's not something which is going to be locked up forever. There are a number of specialist things that can be done with regards to accessing money within the QNUPS, which we don't want to go into now, but to be more than happy to talk confidentially and privately with you as we reach situations where they could be deployed. Obviously, commercial property is something which can be invested within a QNUPS. But also residential property can be invested. So there's a big difference there between a SIP and a SSAS. There's no limit to the contributions that can go into a QNUPS, but it's important that you realise you're not getting tax relief on contributions going in. These are personal contributions of either cash or investments or property into a QNUPS for your retirement. And the only issue there is the inheritance tax relief that you get on funds within a QNUPS. We have to be careful that we don't overdo the contributions. But again, we will provide you with all of the technical support and implementation support as we go through. There's no lifetime limit on the fund size, so there's nothing wrong with a QNUPS becoming worth 2 or 3 million, or 5 or 10 or 15 million. It's really down to your circumstance and your need. So this is one additional arrangement that you may or may not have heard about. They have been used for many years and they've had a few changes lately. So again, need to be careful that you are being given the most up-to-date information. Our role in all of this is to orchestrate the other professionals to make sure that at every stage you're given the correct advice, tax advice, actuarial advice, accounting advice, and so on and so forth. But what we don't want to do is to cuckoo out and embarrass or remove any of your existing advisors. We do need to make that quite clear. We will be working alongside them to implement any planning. Another arrangement that you may or may not have come across are property trusts. There's a thing called an EPUT, and you're probably wondering what that stands for. It's an excluded property unit trust. And I don't want to go into too much detail other than to say that you can put residential and commercial property into an EPUT, and once the property is within the EPUT, investments are in the units of the unit trust. So if you have a pension and it is buying units in an EPUT, it doesn't matter that the EPUT itself is invested in residential property or commercial property, because the pension is not investing directly in the property, it's investing in those units. Again, it may be a subtle thing to you, but under pensions legislation it's a very important distinction. Commercial borrowing limits within an EPUT are as normal. So you approach the bank and you explain to them about the rental income or the lease income on the property, and you can borrow. There's no 50% of the fund limit as there is with a SSAS, so you can have much higher borrowing limits within the EPUT. Again, from a lot of the planning work that's been done in the past, having that additional borrowing is a valuable thing for cash flow right the way across the board. There's no capital gains tax, which is beneficial within an EPUT. So as properties are being bought and sold, they're sheltered from tax on gains. Interestingly, also, there's no annual tax on envelope dwellings because an EPUT is exempt, which will save people a fair bit of money rather than holding properties within a limited company or a trust. It's the units that can be bought and sold, not the property, which also has implications for passing money to the next generation. You don't have to be selling a property, you don't have to pay stamp duty on buying new property, you can move units around, and that's quite an important thing for succession planning. But again, trying to keep this light and overview-like, I don't want to go into too much detail. So there's some new toys on the table, and let's look at some examples of some planning. I'm going to just pick out 3 examples of things that have been done recently. Again, this isn't everything that can be done, it's to give you a flavour of the sorts of things, and hopefully that'll prompt you to get in touch, and then we can find out what your situation is and put a proposal together for you. So we've got a couple of properties here, and they're owned by a couple. Straightforward buy-to-let landlords, and they getting serious about things, and they take advice and they do things properly, and they've been told that perhaps they ought to have their properties within a property company. And again, there's a process where you can go from personal ownership through to company ownership without triggering taxes. But again, that's not the objective of this little video, just to explain that that process needs to be properly managed. So the couple, instead of owning property, they now own shares in the property company. And that's quite an important distinction, because when you sell and move shares around, stamp duty on those is considerably different to when you're selling and moving on property. So, straightforward situation, and here comes the first little difference. The couple decide to set up QNUPS or QNUPSs, you can have one each, and from there they transfer their shares into the QNUPS as a contribution, and this first step will require an actuarial report to confirm that the value going into the QNUPS is realistic. Just to put things in perspective, it has to be realistic value going into the QNUPS in order to purchase the income that is needed for retirement for the individual. And again, making sure that this is done properly, I can't stress enough how important that is, and that's our function, make sure that that's all done properly. So the property company is no longer needed because the shares are within the QNUPS, so we wind the company up, and at the process of winding the company up, the properties move into the QNUPS, and so the shares and the company vanish, and we've now got a QNUPS holding and owning the property. Next step is an EPUT is established, and the property is moved into the EPUT in exchange for units in the EPUT. So now we have a QNUPS containing units and an EPUT containing property. And there's no inheritance tax for the couple. There's no capital gains tax. There's no more annual tax on enveloped dwellings. And there's less tax on rent. So their situation suddenly becomes a lot more flexible and a lot more tax effective. But like I say, every single step needs to be looked at and done properly. And from the couple's perspective, it needs to be something which is economically advantageous for them as well. So it's not just about doing things for the sake of it. And again, that's part of our free consultation at the very, very beginning. It's to find out your situation in terms of values of properties and so on and so forth. So that's just one quick example. Makes a big difference to the capital. Next one, we've got a collection of individuals, 4 of them in this case. They have a trading company, and that trading company owns a property. In fact, it's the property that they run the business from, and a number of business owners have been advised that they should use their company to buy a property. And they've got a mortgage on the property, and they've also got taxable profits on which obviously they pay corporation tax. So a standard entrepreneur running a business type arrangement. 2 of the individuals have actually got SIPs, self-invested personal pensions, and the pensions have got some money and a property. So between them, that property is 50-50 owned within the 2 SIPs. The 4 individuals sit down and get some proper advice, and they set up an arrangement called a DB-SAS, and that stands for Defined Benefit SAS. And again, don't want to bore you too much with the details, but it means that that £40,000 contribution limit could, under the right circumstances, be massively exceeded. So the 4 members in the pension, company pension, make a very large contribution, and the company gets tax relief. So the taxable profits are gone or reduced significantly, saving them corporation tax. Next, they set up a good old EPUT. And then the next step is the SIPs. First of all, they transfer their money into the SAS, because a transfer from a SIP into a SAS is a perfectly legitimate thing to do. And so in this case, we're transferring the money and the property from the 2 SIPs into the SAS. And the way that we do that basically moves things directly straight into the EPUT. And the EPUT, which has received the money and the property, hands over EPUT units to the SAS. So now we've got an EPUT which contains money and also property. And we have a SAS that contains units. Trading company still has a mortgage, still has a property, and the 4 individuals are happily getting along with things. However, the EPUT's cash may well be used to purchase that property or pay off the mortgage. So now we've got the commercial property within the EPUT, and the company has paid off its mortgage. The EPUT receives income because it leases the commercial property to the trading company. It also obtains rent, so it can gear up and it can mortgage, and there's lots of things that it can do with regards to its units and the members. Lots and lots of different bits of planning from this point forwards, but again, we've actually saved the business from receiving such a large tax exposure. We can pass money via the EPUT units down through the generations. Again, don't want to get too technical, just to give you an idea of some of the scenarios where we have and can be doing things that are beneficial. So that's second example. Third example, we have a couple and they've got a limited company which has got money in it, and they've also got a director's loan, which means that the company owes them money. And there's a whole raft of situations where people end up being owed money by their limited company. One of the problems there is if the company were to repay that loan, the money would become part of that couple's estate for inheritance tax purposes, and therefore would suffer 40% tax. The other thing is, if that director's loan were to charge interest, the individuals who receive that interest would have to pay tax on that interest. So they can set up 1 or more QNUPSs, and they can transfer the director's loan as a contribution into the QNUPS. Nothing wrong there. It's a director's loan with a particular value, and that value now resides within the QNUPS. It means that if the company were to repay that director's loan, the money would be sheltered from inheritance tax, and any investments made within that QNUPS, in whatever field those investments are made, they'll be free from capital gains tax and inheritance tax. So a much more effective investment vehicle. But it also means that the limited company can make payments of interest to the QNUPS based on the fact that there's a director's loan that can charge interest, and a QNUPS does not pay tax on those interest payments. The limited company, on the other hand, can offset those interest payments as a business expense. Don't forget, we've got the shares, and also the QNUPS now has cash. And as an aside, there's nothing stopping the QNUPS from spending that money and ending up with the shares within the QNUPS. This might be something beneficial because each individual has their entrepreneur's relief, so they can sell shares at full, proper, independently valued market price, and they only pay tax at 10%. If they were then to sell or float the company in the future, those 200 shares may have significant value, but there would be no tax on the uplift at all. And also there'd be no tax in terms of inheritance tax on death after selling the business. So there's a great deal of things that we can do. Again, just throwing out a couple of examples to whet your appetite and get you to get in touch. All of this may sound complicated, and I do apologise if it does. The key thing is you really do need some professionals around you to implement things properly. We've got QNUPSs, we've got SIPs, we've got SSASs, we've got EPUTs. All of those may seem like one step too far in terms of complexity and jargon, but I promise you these are all things that we're familiar with at this end. I've been providing support for IFAs, accountants and solicitors, and indeed some of my clients are in fact accountants and solicitors. So just because someone is an IFA or a solicitor or an accountant does not mean to say that they are comfortable dealing with these sorts of things. We've got access to tax advisors, we've got access to the actuarial reports, the trustees, the administrators, all of the professional tools, all of the professional advisors that you need, we've got access to. We're not going to do anything lightly. We want it all to be done properly. And everyone that we work with has got fantastic experience and knowledge. And we're here to deliver the best outcome for you. I know that we're not supposed to do things purely because it saves tax, but there is potential to make massive tax savings if things are done properly. And it would be a shame if you were to miss out just because you sat and thought, well, I've read something on the internet that says that you can't do this. Let us find out what your situation is, and we're offering you a free consultation. So get in touch. Elite Wealth Services. If you email us on property@elitewealthservices.com, you will get an automatic response, and that response will have my mobile number, and you can get in touch directly, and we can organise to have a good talk, half an hour on the phone, free of charge, and I can establish whether there's anything that we can do for you and move things forward to the next stage, which is to sit down and meet and become formally engaged. I do hope some of this has been useful, and I look forward to speaking with you soon. Thank you very much.